what's going on with the US, right? How are we going to move that wave as African founders, essentially?
The US, since the Trump presidency, has really taken a very nationalist stand. It is more so US first, right? They are protecting, as any nation should, protecting and working towards their interests first before the rest of the world. We definitely need to shift away from the narrative of aid. I think African businesses need to come to the table saying, hey, there's a real opportunity. We might be starting from a lower economic standpoint compared to, the US economy, but we have a far greater potential over the long run. And on an FX adjusted basis, so if you had invested in dollars on January 1st of 2024 across the market, on average, you would have, on an FX adjusted basis, outperformed your investment in the S&P 500.
Wow.
And that is a little known stat.
Yes.
So there's first indicators of US capital turning back onto the continent. Why? Because A, you're about to get into a risk-on environment.
Yes.
The Fed just most recently didn't move interest rates lower. Once it starts going down, unless there is a major shift in the economy, they will continue going down. So if interest rates go down, you get less for your money sitting in the bank.
True.
So what are investors going to do? They're going to go and start looking for risky capital. So I think that as interest rates in the US come down, and as African businesses have built more resilience, you're going to get to a point where capital willing to go to the continent will meet businesses that are stronger, hence a more symbiotic capital raising opportunity. And the last piece is, with AI, African businesses will actually need less to start, right? To start their business or run certain parts of their business, hence will make the need for initial capital lower. So with those two trends, I'm very optimistic for fundraising on the continent.
Good evening, and thank you so much for being with us tonight.
Thank you for inviting me.
It's a pleasure to have you in the beautiful town of Atlanta, in the fantastic space of clean energy culture. So thanks so much for taking our invitation and talking about the US relationships with Africa. Let me tell you from where we're from, coming all the way from Kenya, 27 hours of flight to really understand what's going on with the US, right? How are we going to move that wave as African founders, essentially? So
Yes.
as we start, and it's been a pleasure to see a little bit how you've grown with Daba Finance from the time we met in Togo when you won successfully the EcoBank FinTech Challenge to now having an expansion of users, $2 million of funding raised. This is great to hear from you. How has those relationships evolved in your perspective, the American relationships with Africa, and how has it affected you personally with your startup, with your FinTech, and how do you see it evolving over time?
Okay. Thank you very much, Melanie, for having me. So for your audience, I'm Boum III Jr., CEO and co-founder of Daba Finance. Our mission is to democratize investing across the continent, helping whether you're a retail investor or an institutional investor identify the best investment opportunities on the continent and invest safely, transparently, and with ease. So that's been a mission. It's been 4 years that we are in existence. We have over 120,000 customers across the world, so US, Europe, but also on the continent. So I hope I can share our experience, the view, what we see is going on with the relationships between US investors and the continent, both at a retail level, but also at an institutional level, and share that dynamic. So maybe I would say, just to set the context, today as we record, right, the US, since the Trump presidency, has really taken a very nationalist stand. It is more so US first, right? They are protecting, as any nation should, protecting and working towards their interests first before the rest of the world. And that is the policy, or that is the That is what American voters have, elected Trump for, right? So that is the agenda that he's pursuing. Now we live in a global world, so Africa is not a monolith. So African countries and African founders, African businesses that have relationships or want to build relationships with the US need to understand that change.
Yeah, absolutely. But the change that we've seen, I think, was quite impressive because we had a lot of I would say motivation of US investors to come into the continent, and like around 2018, 2019, and we saw a lot of capital flowing, a lot more VC funds being created. Everyone wanted to come into the African continent. It was sexy.
Yes.
It was interesting, exotic somehow.
Yes.
But now, we feel that everyone's talking about this funding winter and this challenges of accessing money. Have you seen you personally a shift into your fundraising journey with Daba, or have you seen even retail investors changing their behaviors in the way they buy stocks and bonds on the African market?
Yes, so I'm happy to share kind of the dynamic from the beginning. So when the African investment boom started, you had essentially an environment where it was a risk-on environment. So US investors were looking or were open to going to the continent to get that alpha, to get that additional return on capital.
I see.
Right? So you are in a risk-on environment. Africa seems attractive. You're starting to get your first unicorns. You're having success stories. So you want to pile into that. Then, and that went right into kind of the first year of COVID.
Yes.
And after that, you had a retreat, right? You had to tighten that economic environment in the US. So what happens? You're in a risk off. So you go from risk on to risk off. So capital is now waiting on the sidelines, even in the US, and it was not only an African phenomenon.
I see.
You have US investors that are also now waiting to invest in, Series B companies, right? So it just trickled down, whether you're Series B, Series A, the threshold for you to get capital was becoming more and more difficult, right? You have to meet certain metrics. You can say investors kind of had a return to investment discipline, looking at numbers, no more vanity metrics. So when you're in such an environment, obviously you have US companies that are also receiving less capital, and you have, African companies on the other end of the spectrum that will be affected because the US investor has more affinity to the US market than they would have to the African market. Even though you had a few US investors that already started making having some experiences on the African market, they still are. The US is still what they know, right?
Yeah,
that is where they have their relationships, where they have the most insight. There are first-party actors in this market versus kind of third-party actors in other markets. So you had a flight to quality. You had also a flight to US investments. Also, why? Because after COVID, you had kind of interest rates that started increasing.
Absolutely.
So that is another kind of dynamic that plays heavily into global investment cycles, whereby the central bank in the US, so the Fed, increased interest rates. So it became more attractive for you to keep your money
Of course.
in the bank, right? Because you're getting what is called the risk-free rate. For not taking any risk, you're getting 5% your money annually, guaranteed by the US central bank. And it's way more attractive for certain investors to say, hey, I'm just going to take my 5% per year instead of investing all the way in Africa, taking a lot of risk and not being sure that over a 5 to 10 year period, I will make more than I would have made just leaving that money. So you have interest rates going up. It's more attractive to just park your money in the US. So why would you invest on the continent? So you have that shift. We're now at a period where the government is incentivizing or pushing actually the Fed to start lowering interest rates again, which in my opinion will make, frontier markets such as Africa attractive again. Now, what this, call it funding winter, has, allowed us to also do a little bit on the continent is have a focus on businesses that should exist a little bit, right? So it was a little bit like a purge, right? Taking away all these businesses that were just kind of like raising on vanity,
Of course.
with no true fundamentals. And those businesses, there were some relatively great businesses that might have not have good fundamentals and were still trying to find the right basis that unfortunately were forced to shut down. But in a large sense, you now have stronger and more resilient businesses on the continent because they had to, go from a period of capital abundance to capital scarcity, yet still try to grow, right? So I think African startups specifically have proven resiliency. And over the next few months, in my opinion, with interest rates starting to come down in the US, we are going to see more capital raising opportunities happen for African tech companies specifically.
It's very interesting what you mentioned, because I feel that what you also proving is that the whole USA debacle is a bit the iceberg, the tip of the iceberg, but that there was really some underlying reasons that were more relying on the risks and the returns, traditional finance kind of principles that applied. And of course, we can imagine that with the USAID coming out, there's also a lot of free capital that were de-risking private capital investments, because when you look at a lot of the key startups like the M-Copas, the Trigger Foods, they had a lot of USAID money, which helped to leverage kind of the private capital that came a lot from the VC articles. But now it's going a little bit lower. And how about now from the retail investment perspective? Because what you said is a behavior we see in our market.
Right.
In Kenya, our government bonds can be as high as 15 to 17%.
Right.
So you can see that a lot of banks even prefer to put most of our deposits into bonds instead of SABs or startups.
Correct.
So what you're describing on the American side, it's very interesting, because that's basically a behavior we see also in our markets. But what did you see from a retail investment perspective on Daba Finance? Did you see more retail investors going for specific products maybe, or do you see a retraction of the investments or an expansion maybe?
Yeah, I'll answer that question. I just want to come back to what you said on USAID. So when President Trump came into office, he is proning values of America first, and essentially putting American interest first. And these companies that were specifically raising capital from, government, or call it taxpayer-funded organizations, and running a business model on top of that, were always open to that risk, right? That capital will dry up, because who is giving that money? It's the US government. Also, why did US capital retract is because the LPs of these VCs were also saying, hey, look, these LPs could be pension funds. So they have, people's retirements. They could be wealth, university kind of funds, right? So you have third layer implications that are saying, hey, the source of the capital that we are entrusting onto you, the investor, to deploy has different parameters now, right? So we want you to be more cautious. So they have to pull the brakes. And the case for USAID was just the most extreme case of it, where the US government said we're stopping it altogether. And that exposed the lack of resiliency in the capital sourcing for a lot of African businesses, not only tech startups, but also, just general everyday businesses. If most of your capital comes from aid, that aid is not guaranteed. There is no contract that says we will, for perpetuity, keep on giving you aid. So how do you build resiliency in your own financing so that you can continue delivering on your core business? So I think the lesson there is not so much so that we should be saying, hey, America, you've abandoned Africa. It's more so, hey, this is a lesson learned. How can we build more resilience in our own financing so that the aid is just a bonus or fills a much smaller gap versus taking up most of our needs. So I just wanted to double click on that because that's a
Very important.
very important shift, especially for African businesses. I think aid has a role. It plays a role. It's very important. It, like you said, it de-risks that initial.
Yes.
But you cannot build a sustainable business on aid forever.
It is supposed to stop.
Exactly.
Like it's actually a slogan of the French Development Bank that they say that their biggest aim is to close the French Development Bank.
That's great, right?
Because it's supposed to stop.
It's supposed to stop.
Yes.
So going back on the retail behavior. So when we started, the initial asset class, the initial investment product that we offered our retail investors was venture capital. So when Daba first started, the first opportunities that were available on the platform were startup investments. And we did that for a few reasons. One, comparatively to the size of the African capital markets, VC is a minute piece. So, tracked African capital markets annually is about $2.3 trillion. So that's stocks, that's bonds, that's listed commodities. So, and private equity. So venture capital at its peak, and that is 2021, is 8 billion.
Yeah,
Roughly. So, it's a fraction. So this is a very insulated kind of asset class that has a lot of hype, hence interest. So that was for us the best kind of asset class to test the key assumption of our business, which is, can we aggregate capital on one side to drive it to opportunity on the other side? So we built the platform around that with that asset class. Obviously, as the market shifted, right, with institutional investors investing less in venture capital, we saw the same type of behavior with retail investors.
Of course.
They are even more sensitive. Why? Because you're talking about personal savings, personal capital. An institution, a VC, at the end of the day, is other people's money.
Of course.
Right? So even though they have to be fiduciaries to the people giving them that money, it is still not their money. So the attachment, right? The ability to take risk is, call it, relatively to an individual investing their own money is way greater. So we saw retail investors on our platform slowly invest less in the startups. And we saw that early on, right?
Interesting.
So we caught that trend pretty early. And we knew, from the beginning on Daba, we always knew that we wouldn't stop at venture capital as the first asset class. Our vision was always to be multi-asset. We want Daba to be the platform or the infrastructure that allows people to invest across any asset class that you can think of: stocks, bonds, mutual funds. If it's investable, we want to be able to support the investment platform and journey into that asset class. So as we saw interest dwindle for venture capital, we were already building our next product, which was stocks.
I see.
So the infrastructure from its get-go, from its inception, was built to be modular. So I spent 5 years at NASDAQ building the stock market kind of investment infrastructure. So from the get-go, my team and I engineered the product to be modular to support other asset classes as we are ready to expand into them. So we saw the trend, we shifted over to allow stocks, and that has now since then been where most of the retail capital goes in for certain reasons. First is day-to-day marking. So essentially the stock price is an active kind of thing. You can see today it's worth this price.
Yes.
For a startup or venture capital, you only get priced when there is a liquidity event. So for a retail investor that does not understand that dynamic, it's my portfolio isn't moving, right? Whereas value is being created in the background. And at the next liquidity event or fundraising cycle, that's when the valuation of the company should increase and you should see a gain in your portfolio value. A lot of retail investors do not understand that. They want that minute by minute live kind of
return.
Exactly. And have the visibility on what is my investment worth. So stocks gives them that. Secondly, the ability to get in and out, right? So you don't want to have your money, especially in a risky environment where you have, interest rates going up, life is getting more expensive, right? So people are, even if they want to invest in the continent, they are thinking, hey, I have responsibilities, I have bills to pay. So I see the opportunity, but how can I balance my risk? So I'd rather go into something that allows me to get out if I need that money. Stocks offer them that opportunity. So we've seen stocks really become the driving kind of like asset class on our platform. And then about a little less than 8 months ago, we launched bonds, which essentially allows now people to have fixed income, right? So we give them access to government bonds, government treasuries, and corporate bonds, which have different interest payments. So they can say, hey, look, I'm gonna lend my money to the government, to a corporation, for them to pay me every 3 months, or every month, or every 6 months, or every year. That again is something that retail investors understand better than saying, hey, look, whenever my valuation increases, that's when you will know if your portfolio is so essentially today we see stocks and bonds being the key drivers. And just recently, less than 3 months ago, we launched mutual funds. And that is really for retail investors that do not know what stock or bond to pick. They're a little bit overwhelmed. They might not have a clear investment strategy. They would rather give their money to a professional investor that has constructed a product, and they can say, hey, look, this is the investment strategy of this product. It's aggressive, it's moderate, it's conservative. I am going to put my money in there and just kind of like see it ride. So that is kind of like the behavior we've seen on the platform for the past few years.
Oh, it's fascinating. I think that like it makes so much sense for you to have diversified that fast, because you have a bond that is less risky as opposed to the VC space. And as you were talking, I actually had this question coming to mind. And from the type of retail investors that you have, how much would you say are from the diaspora? Because from our experience, the African diaspora has this bond with the continent, but there's a bit this love and hate relationship where they have maybe sometimes their own prejudice about the continent,
Right.
more than someone who was not from there.
Yes.
And they might actually feel more risk, even they perceive the risk even higher priorities. So do you see a lot more diaspora coming in, or is it a majority of foreign investors?
Gotcha. It's a great question. I think, and within the diaspora, there are different layers. Today, from 120,000 customers, about half are from the diaspora. So are from US and in Europe. And I would say within the US and Europe, about 80% are probably diaspora investors. So we have this category called Friends of Africa, and then we have the African diaspora in US and in Europe. And I say US is also kind of like North America. So we have quite a bit of users across Canada as well.
Oh, wow.
That are using our platform. So essentially, you have these kind of like either first generation, second generation. They have, it's a little bit of kind of like, kind of like that bias. Like, is when you have knowledge, you come from a point of kind of like, you might have some bias, right? Because you might have been burned, right? Like you might have, gotten into a business deal with a family member back home. It didn't quite turn out as you planned. You might have, kind of like, done an investment because you couldn't be on the ground. It didn't quite work as you intended. So they come from that point of a little bit of distrust sometimes. Others might be more optimistic. They understand the narrative. They aren't there. Eventually, they'd like to go back. But how do they start building wealth on the continent in anticipation of that eventual return? Others care about impact. So we've seen kind of like a differentiation within a diaspora kind of like user base. They have different motivations, right? And it is up to us, right, the people that are in the space, to give them the elements, the certainty, right, that, hey, based on your investor profile, based on what you care about, here might be, right, the types of investments that you might want to consider. Because this type of structured investment kind of like service it's not, I want to say, democratized across the continent, right? The people that get access to tailored investment services are the wealthy.
Yeah.
Like if you have money on the continent today, you could walk into any bank and ask for their private wealth services, and they're going to roll out all the products that they might have
very easily.
and you will make money. I mean, they make money for their clients. The threshold is just too high, right? Depending on the country, they're gonna want for you to have $1 million worth net worth or more, right? And liquid, like, because you need to hand them that money for them to invest it. And given that most of the wealth management services are also tied to banks, it's a virtuous cycle within which they can provide value for their customers and also good kind of like financials for their related parties, which are the banks. It works, but only for the wealthy people, right? So you in the diaspora, somebody in the diaspora that wants to invest on the continent, does not have $1 million worth, is not on the ground, how do they get started? They need to have an anchor, right? A platform, a trusted party that they route their investment through. So we accompany them in that journey. And on the flip side is building trust with the local actors, right? The banks, the asset managers, the brokerage companies that already offer that service, though they do not talk to that customer base, and be the bridge. So that's essentially how we kind of like bring the diaspora into investing on the continent in a safe and transparent way, something that they're more used to with the services here in the US, such as like Robinhood or TD Ameritrade, whatever other kind of like financial service provider that might have the habit of using, and we give them that same experience, but the underlying asset is on the continent.
It's very impressive because I think it's a very difficult clientele to mobilize. And I think that it's also because it's really not well known, the profits you can make on the continent. And every time I tell even by my own family members, they get really astonished by the kind of like coupons we can get from our government bonds and from our corporates. From what you've seen with Daba Finance and what you guys offer, like what would you say the range, like could you give us a bit of flavor on the returns? And do you see certain products outperform, like for example, now that Trump is also in power, we see a big rush towards more commodities, or we see a devaluation of the dollar against like African currencies. Do you see any like opportunities coming up also for us on the profit perspective?
Absolutely. There's a lot of opportunity. And it's actually very interesting because last year, so the stock exchange that we've started with is called the BRVM. And it's Africa's 5th largest stock exchange. Total market cap about $30+ billion. So relatively small to the US market, but a significant amount, or a good amount for kind of like the size of stock exchanges on the continent. And on an FX adjusted basis, so if you had invested in dollars on January 1st of 2024 across the market, on average, you would have, on an FX adjusted basis, outperformed your investment in the S&P 500.
Wow.
And that is a little known stat.
Yes.
Since the beginning of 2025, if you remove, so a lot of the 70% of the growth in the S&P 500 has been driven by the Magnificent Seven due to kind of like the hyperscalers, due to their investments in AI. So AI has been the driving force of the S&P 500. Now, if you remove those and if you remove those kind of like those Magnificent Seven and from the S&P 500, and you look at the returns, the market that we're focused on is outperforming on a lot of metrics that the S&P 500 on an FX adjusted basis. Now, because we are in a very fluid kind of like environment, like the environment is very dynamic. President Trump, even though he doesn't admit it as much, uses the stock market as its report card. He wants to instill confidence for investors in the US market. He wants to drive investments into the US. So it only makes sense that the US stock market is his scorecard. Mm-hmm. So the tariffs and the policies that his administration is putting in place have various effects on the stock exchange. So depending at the point, like the point that you look at, you might be at a point where the African exchanges are massively outperformed. And you might sometimes be at moments where there is either a match or a slight underperformance. It depends on the window that you're looking at. There was a specific moment in March, because I think so after his inauguration, January 20th, and then there was Liberation Day sometime after. There was a period in March where the the BRVM was largely outperforming the S&P 500. I mean, the S&P 500 was negative on the year. So you have those moments where as an international investor, there is an opportunity to seize, right? But if you do not know, then you're not necessarily gonna make that trade. And that is just a story of the market that we cover. Those opportunities, as part of our newsletter and kind of like our market analysis, we look at kind of like stock movements across other exchanges, and those types of opportunities exist across other exchanges and marketplaces. You just need to have the right insight, the right partner, and the right kind of like flexibility to be able to seize those opportunities when they arise, and not be kind of like, flat-footed, when the tide might shift.
No, absolutely. And I think you said some key stats here, and this is absolutely like, for me, it's not surprising, but it's really impressive to hear such numbers. And at the same time, it makes me very frustrated that we don't have the kind of data, we were in Zambia at the Bloomberg conference earlier this year in June, and we were discussing with Bloomberg about the lack of data, economic and financial data about the African continent.
Right.
And I'm very impressed about how you've managed to navigate this gap with Daba Finance, because for a lot of investors, the key of having liquidity in the market is because you also have access to data, so you can predict, you can forecast, and then you can basically play a bit better with the market. So how do you manage that for your investors? How do you manage to also give some kind of transparency about this data? What kind of information sources you use? Because for our audience, this also could be very good tips that they could use for their own business or their own investment.
Yes. So we are in a privileged position, which is we effectively are an investment aggregator, which means that we aggregate all the different investment products that exist, and we distribute them through one singular platform. It could be our app, it could be our APIs. Now, because we're an investment aggregator and because we have partnerships with different stakeholders, we have access to information. And that is that information that we simplify and make available to our users. So we collect a lot of insights on, kind of like the daily kind of like market movements, investment reports, investment commentaries, independent sources, brokerage sources, right? And we compile all of that to make give the best guidance possible to our users. It's not perfect. We have the chance to be in a market that is in an upward trend. Since 2020, it has been in an upward, consistent trend. So the market, essentially, you could have just invested evenly across all the stocks on that exchange, and you would have still made money.
Wow.
Right? So now, what we're trying to get is that edge. How can you make more, right? So that is where the insight comes in, and we are in a very privileged position of having access to that insight through our partners, through the infrastructure play that we have, or the infrastructure role that we have, to then surface that insight to our users.
Amazing. Now back to the startup space. We have discussed a little bit about this VC rush towards African startups. How do you see now the appetite of your institutional and retail investors on African startups? How do you see it evolving over time? And do you think a lot of articles that we've seen that the American VC model in Africa is kind of dead?
I would say this, as an operator on the continent, the pace of execution on the continent is different. On the continent, you're in a marathon. You're not in a sprint. So if you understand that, if the investor understands that, the type and the structure and the expectation of the capital varies. If you were on a 5-year horizon, you stretch it to 10. If you're on a 10-year horizon, you stretch it to 15. But the good news about the African market is because it's so nascent that you can build champions and you could build companies that are deeply rooted in the fabric of what they do in such a way that you actually have big businesses that can emerge. They don't emerge over 2 years, right? They don't emerge over 3 years. It will take 5 years. It will take 10 years. I mean, we're not a huge business yet, but I can tell you that at a micro scale, we have seen the shift. I mean, today, just on our trading volume, we are 15 times on a year-over-year basis what we're doing last year.
Wow.
15 times. I mean, I crunch our numbers every month, and sometimes I'm astounded because the compounding effect on the continent is tremendous, but it takes time to get to that escape velocity. In the US, because you have infrastructure, because you have systems, because you have capital, you can go from 0 to 100 real quick, like they say, right?
In a few years.
But on the continent, it takes time to build those roads. So investors need to understand that if you believe in a company, if you believe in a mission, if you believe in the team, because it's about the team, and the general business strategy, especially at the early stage, you have to trust that team with the capital that they have will figure out a business model that will scale and that will eventually, not over a super short time horizon, but eventually give you the return that you're looking for on your invested capital. On the flip side, the entrepreneurs, they need to understand that yes, you need to execute fast. I mean, you need to execute fast. But the truth is that fast on the continent could be like if you were kind of like on a track,
yes.
And let's say, you know, on the continent you are like full speed, 100%. At best, here it would be equivalent to like 50% at best in the US. Like just because every problem that you face and that you're trying to solve along the way to get to your end product on the continent has its own can of worms, right? You need to collect payments and then you don't have reliable payment service providers. So now you're trying to find ways to maybe build redundancy in your payment, right? You're trying to distribute, you have a logistics problem, you don't have a reliable logistic. So like you start solving these micro problems all to get to the top problem, and that takes time. But as you do it, you're also building your defense, right? Because anybody that's coming behind you will have to go through that, and you would be years ahead, right? So as an entrepreneur on the continent, you need to understand that yes, you want to go fast, but you need to go fast within your context is different than fast within the context of the people that are giving you the money in the US and in Europe. So if you have a shift in the understanding and expectation from both parties, you can actually get to a very well thought and with great expectations financing relationship between US capital and African entrepreneurs. I believe it's possible. And just to talk about the shift, I am very optimistic. Why? Because you are, again, with interest rates coming down, you're going to see risk on. AI right now is the isolated, like the single most, so there are two trends in my opinion. So there's first indicators of US capital turning back on to the continent. Why? Because you're about to get into a risk on environment.
Yes.
The Fed just most recently didn't move interest rates lower, even though the Trump administration wanted them to bring interest rate lower. Once it starts going down, unless there is a major shift in the economy, they will continue going down. So if interest rates go down, you get less for your money sitting in the bank.
True.
So what are investors going to do? They're going to go and start looking for risky capital. Now, where do most of the investment go today? In tech is AI. But if you peel that layer on and after, because we're going to reach a saturation point at some point, right? Because the investment And today, most of the investment is made by the hyperscalers, and not everybody can access that. So to access hyperscalers, you need to invest in the stock market, right? So, you need to go elsewhere. So some of that risky capital will find its way back to Africa. Now, African businesses, because they will be coming out of that drought, will be more trained, right? Trained to deliver value instead of just vanity metrics. So I think that as interest rates in the US come down, and as African businesses have built more resilience, you're going to get to a point where capital willing to go to the continent will meet businesses that are stronger, hence a more symbiotic capital raising opportunity. And the last piece is, with AI, African businesses will actually need less to start, right? To start their business or run certain parts of their business, hence will make the need for initial capital lower. So with those two trends, I'm very optimistic for fundraising on the continent.
I really like your optimism, because I did come to America being very pessimistic. So I like it. Gives me a bit of hope. And I'm thinking that what you said, especially at the beginning, about the fact that we have, for us to successfully raise our business and scale our business, we actually have to solve a lot of micro problems around our main problems that we're solving. I think this is so key, and this is what was so difficult to also explain to an American investor. When you're doing, for example, electric vehicles, why are you also doing the charging and the financing of this vehicle and this and that? And it's very difficult to explain and to put the right narrative around it. And I think this is where I also want to go, because after all this dodging and all these discussions around America first, and now we don't look outside, it seems that we've come some step backwards on the African narrative, with a little bit more vision about African investments being more philanthropy than actually for profits, or not being necessary, while even all this USAID funding was an investment for the US, because it is basically diplomacy and soft power, essentially. So how do you see the narrative shifting, and what advice could you give us essentially on how we can reframe that narrative towards international investors, and in particular in America?
Right. We definitely need to shift away from the narrative of aid. I think African businesses need to come to the table saying, hey, there's a real opportunity. We might be starting from a lower economic standpoint compared to the US economy, but we have a far greater potential over the long run. So we need to bring these US investors to take a wider lens, right? Do not take a very narrow lens, and understand the fundamental investment opportunity. And the fact of fundraising is what I understood over time is you need to talk to investors that are ready to take the risk at the stage you're on. Because I think one of the other things is, it's you have these lists that go around, and you have people that say, here are the list of investors that invest in Africa, and you have these spreadsheets going around. But the truth is that those investors on that list, are they really investing A, in your sector, B, at your stage, and truly do they have the knowledge to understand and make the bet that it takes at the stage of the business that you're at? And if you go from that lens, you're gonna a lot of those lists for a lot of founders will not be useful, right? Because you need to find search. And today we have the internet, we have AI, we have all these things that allow us to search and be more efficient in deal sourcing, investor sourcing, and all these things. Take an approach of, what is the fundamental hypothesis or assumption that I'm trying to prove at this stage? What are the proof points that I have that I'm going to solve this problem and answer this hypothesis? And how can I convince somebody who has questions about this hypothesis at this stage? If you narrow down, because we have the big picture, we have the big vision, but as you're talking, it's your fundraising, you need to narrow down the story to that point that the investor will latch on. And as they've latched on to that point, then you take them behind the curtain. So like as they build interest, they're like, oh yeah, okay, yes, I get this specific point now. Let me take you to and then you as the founder, as the entrepreneur, be like, okay, cool, you've gotten this. Now I'm gonna take you on to the next point, because once we've solved this, you take them along versus, hey, here's all this information, just dumping it on them. They get confused, right? So in the conversations that I've seen the most effective for me is when I've been able to really start small and gradually bring the investor along the journey for them to see, okay, from this point I go there, from this point I go there. And sometimes I've been in meetings and they're like, you know what? In our first conversation, I didn't get it, but now I get it. But like, we're like 3 conversations in, right? Like, so you need to bring them in that journey. If like, that's the best advice I can give, right? So narrow down your starting point, find the people that can journey with you from that point, and then unlock, unveil, reveal gradually as you've built understanding in your business and what you're solving.
Thank you so much. I think this is particularly important for every entrepreneur that is actually listening, because we have a tendency of bringing too much information on the table because we're very passionate also about what we say. And so, but you realize that even in America, that's not really how it's being pitched. Like in America, you pitch in a very concise and very fast way, and you need to get very fast, like where is the scalability, where is the opportunity. And as we wind down with the last question of this show, like I would like you to maybe share a little bit of tips for the ones that are in Africa and that would want to access venture capital investors in America, either through your platform or through other means. Like, what would be the pathway for them to access to those investors? You've explained how you present it, but how do you actually finance and how do you target them?
Yes. Number one, I think it's very important for a lot of African entrepreneurs to understand that not every single company is venture backable. Because a lot of founders and entrepreneurs, they say, hey, I need money, I need VC. No, you need to understand, what business are you in? Is there a better way to structure your current financing? How do you go and get it? So once you've determined that, yes, indeed, you need venture capital, depending on the stage of your business, there are multiple paths. Today, I still find certain accelerators to be useful to give you exposure. So that could be a means. Accelerators that give you exposure to US investors, because they've done a little bit of the job, right, of building that bridge between US investors and African companies. So find the right accelerator. There are a lot of resources online that people can search. And also be visible, right? Leverage social media. LinkedIn, so great. I mean, they're all on there, right? All the investors are there. Twitter, right? So they're very active on X. So leverage social media, become a thought leader in your field, garnish attention, make people notice you. When they notice you, they take interest. This person said something very interesting about this, but what do they do, right? And that could build a relationship. And I think a lot of entrepreneurs, and rightfully so, do not take the time to kind of like also polish a little bit of that personal branding, but it plays a role in, because at the end of the day, we're humans, right? So investors back people that they relate to, right? Either they relate to your story, they relate to the problem you're solving, they relate to something that you say, how you say it. So I think if I could give an advice is find exposure, whether it is through accelerators or by building your own personal brand, and you have to stay consistent. The success rate from conversations to, kind of like financing is very low. If you have 100 conversations and one person kind of like writes you a check, it's a 1% success rate, but that is still above kind of like what a lot of people face. So you have to stay committed to the fundraising journey. You will take a lot of no's, but each of those no's should be steps closer to that yes if you listen to what they say and you tweak back to that tweaking point, tweak your message as you go along. That would be my advice.
Well, thank you so much for your advice, Boum. I think that there is a lot that we learned from this conversation, and especially like some key hidden gems that people usually forget. So thank you so much for taking the time to come on the Melanin Means Business show. And thank you very much to the Clean Energy Culture for bringing us this amazing space. We look forward to following your journey. And of course, for everyone interested in investing, go on Daba Finance so that you can be able to improve your wealth and get access to all those opportunities on the continent.
Thank you for the invitation. It was a pleasure.
Thank you.
Thank you.